Good evening, everyone. It's Sunday, November 15th, about 8:30. Just a quick video to go over how the SPYs, the Qs, and a couple of ETFs are shaping up on the DeMark indicators. First off, it's about 8:30 at night, 20 of 9, and the futures are up just under 1%. So what you're going to see here are the charts as of the close on Friday. Starting off with the SPY, which is probably the most interesting and the most telling of the broad indices. I had mentioned on Twitter last week that things look confusing, and I think this probably shows that scenario or that backdrop as much as anything. For those who follow DeMark, you can probably see very easily and right away that the SPY printed a 9-13-9 indicator on the close on Friday. This is probably the most powerful exhaustion pattern, and since this is to the upside, it would indicate that the run-up that we have seen over the last many weeks and if not months should be exhausted. However, the trend, as you can see, has been really powerful off of the just after the elections, and to try to trade such a move without confirmation that there has been a certain level of exhaustion seems pretty risky to me. The first level against which one might want to lean short is the secondary exhaustion or the risk level from the countdown 13 that printed over here, and that's up to about 364.90. If the price gets to that point, it would offer a fairly low risk try at a short position. But considering everything else that I will be talking about later, it's probably more prudent to wait for a bearish price flip rather than trying to anticipate that the move up has in fact exhausted itself. There's another worry for bears here, which is the TD prop exhaust up level. Now, this level has not been qualified at this point, so it does not read as a target. For now, it would simply present resistance. However, if the pattern qualifies the TD prop indicator, then bulls are looking at a possible run up to 390, which is a fair piece from where we are. So on a daily standpoint, yes, there is a very powerful upside exhaustion printed on Friday, but there are also a number of reasons why it will pay probably to be cautious and either wait for confirmation or at least wait until price approaches the risk level at 364.90 for a little better entry. Looking at it on the weekly time frame, you can see that here it's only on bar 2 of a new sell setup, bar 5 of a countdown sell. So everything at this point would suggest that prices are going to move higher. Something that I mention often is the 3 months VIX curve, which has normalized significantly over since the conclusion of the elections. And I'm going to pull it up. Those of you who follow me know that levels in the +5 or above generally signify euphoria in the equity markets, and negative levels, especially -5 or below, tend to indicate panic. After the elections, the pretty deep inversion that existed, and justifiably so, as people were lining up for possible screw-ups during the elections, has disappeared, and now the VIX curve is about a couple of points to the positive, which tends to be the sweet spot for equities. This is where there is enough distrust by bears and enough concerns by bulls to create the proverbial wall of worry. So put those two things together, and I think it probably pays to continue riding the wave up, although certainly things could change. It's simply very confusing. To add to the confusion, the QQQs show something rather different. So on a daily basis, there has been, I'm sorry, this is weekly. On the daily basis, there's just no pattern to look at. You can notice there have been no sustained counts, either up or down, since the end of August. A sell setup just started on Friday, but there's really nothing to go on to suggest that the Qs will get out of this trading range they've been in for a while. If you look at it on a weekly basis, there is a completed countdown sell over here with secondary risk all the way up at 335. So relying on this countdown sell seems very risky again. There's a lot of upside potential for secondary exhaustion. Also, on Thursday, or I should say 2 weeks ago, there was this TD line that qualified, that broke on a qualified basis, and that targets up to 334.80 as well. And last week printed bar 2 of the sell countdown, I'm sorry, of the sell setup. So here too, there is very little to suggest that price is going to break down. Now let me move on to a couple of ETF, the IGV, which is the much followed software ETF. First, on a daily basis, this looks pretty bearish. Completed buy setup over here. The ongoing countdown buy is only on bar 6. Price stabbed below TDST level down, although the break was not confirmed. And there is still a TD prop exhaustion down target down at 291.35. Now, there's a caveat here. On this particular low back on September 18th, price got within 50 cents of meeting the target. Whether that satisfies the indicator or not, it's more art than science. The indicator is still active, as you can see, but there can easily be an argument that it should have been satisfied around here. So this looks bearish. And let me go to the weekly. Bar 11 of a countdown sell, and there is a bar 1 of a TD buy setup. The prop momentum target down here at 291.45 also still shows as active. So again, more signs of upside exhaustion on for the IGV, both on daily and weekly time frames. Let me then switch to the XLI, which is the industrials ETF, and you will see something completely different, and I'll try to sort of sync the two together after I show you this. So on a daily basis, completed sell setup on Thursday. There is still an active TD prop exhaust down target at 82.33, although that's not very far away from where we are. So we would expect a few days of pullback or pause after this 9 print, and then the continuation to a countdown sell 13. So this looks pretty bullish. On the weekly time frame, the 9 expired, and now the 13 is counting out, and we're only on bar 3. So this looks very bullish as well. So how to reconcile the SPYs, the Qs, the IGV, the XLI? Well, the most obvious part would be that the market is undergoing, quote unquote, a healthy rotation out of expensive Momo stocks and into the post-COVID recovery type names. That's the optimistic approach, the glass half full approach, and it may well play out. Rotations typically are, you don't find rotations if there is an impending bear market. At the same time, if I can talk a little bit about fundamentals, credit is still very strong. And we're actually starting to see a little bit of new buyback announcements coming out. So there are optimistic signals out there that maybe the market is in fact looking through this COVID surge and onto a recovery. On the flip side is probably my ears to the ground as to what's happening, especially in commercial real estate, and but also in the distressed debt world and the restructuring type firms. The latter are being swamped. They do not have enough people that can work on all the requests for restructuring advice. Commercial real estate is a wreck, and that goes for everything except for the industrial space, warehouses and things of that sort. Commercial real estate office is trying to paper over the disaster. Retail is pretty much tossed in the towel, and they're giving properties back to the lenders without even fighting it. So there are some very serious problems, I think, in the economy. Again, whether the this wave of COVID is ultimately going to show that the consumer is tapped out without further stimulus, or whether the Lazarus that has been the consumer for decades, I guess, comes back to life again and rides us through to the other side of the COVID panic. I don't know what the answer is, and I suspect that anybody who tells you that they do have the answer is probably making it up or trying to sell you something. The reality is that the charts are bullish in some regards, not so bullish in others, and flat out inconclusive in other parts. And then you can have an argument about what's going to happen with COVID, stimulus, the economy, and everything else, and find good arguments on both sides. So for the time being, my approach is simply to follow what the indicators suggest, which is mostly to ride the upside, at least for now, but with one hand up that things could change very, very quickly. I hope this helps, and I will talk to you next video.